Hi. What is happening with the market in the Hudson Valley and Catskills between now and the end of 2022? That is what I've been spending a ton of time thinking about, guessing, reading, looking at reports, looking what other people are predicting, trying to think about how that impacts our own local markets. So I wanted to do a webinar here on that exact topic. A little bit of what's happening right now, but also kind of what are we sort of seeing till the end of the year. So I'm Megan Brenn-White. I'm the founder of and associate real estate broker with the Upstate Curious team of Keller Williams Realty Hudson Valley North. So our team is the largest team in the Hudson Valley Catskills region. We cover about 8 counties, focusing to some extent on Ulster, Sullivan, Dutchess, Green, Columbia. It's hard to say exactly. And a lot of our buyers and sellers are sort of part of the greater second home market. So that is a lot of what we're going to be talking about here are people who are either, have a second home or are moving up here from New York City or other places, and how different trends might impact that more or less. So here we go. Let's get ready for the ride here. I think that I can just start at the end, and you guys can absolutely feel free to put comments, questions. If you have anything else that you disagree with something, you have a great news article to share, just throw it right in the chat. I would say that, to give the ending at the beginning, that I don't think that by the end of the year, there's going to be massive price increases. I don't think and again, these are just from now on, these are just going to be my opinions based on what I've been, reading and absorbing. And whatever, if it helps you believe me at all, I also studied government and economics at Harvard undergrad and London School of Economics as a master's degree. So that was what I did before I did this stuff and marketing. So, it looks like they're, if you're a buyer and you're sort of yay, we're going to go back to prices from 2018. I would say there's no indication that that's going to happen. I do think that there is an indication that prices could actually go down, not just what people had been saying a lot at the beginning of the year is that the prices will just increase at a slower rate, maybe just increase at 4%. But so many things have happened to change the market quickly that I actually think we will see, and probably are seeing price decreases, actual decreases already from year on year. And, because things have gone up so much over the past 2 years, that still doesn't even if we went down 10% by the end of the year, which I'm not saying we necessarily will, that still doesn't even get you close to those pre-pandemic prices. So I think that's one thing, is that I think that there is going to be, and there is also already more, we'll put it discernment for buyers currently. So we had a time period where buyers were I just need to get a house. I'm losing a ton of multiple offer situations. I'm willing to accept things I wouldn't have been willing to accept 3 months ago. Maybe I'll get a house on a road, or a house that needs a little bit more renovations than I wanted to do. Basically, what we're already seeing is that the houses that have some challenges, totally traditional challenges, the same kind of challenges that we would have talked to sellers about or buyers about in 2019 or 2018, those houses are not, getting some incredible price, multiple offers, et cetera. That is a big difference. So, I always want to preface this by saying that to some extent there are 2 parallel markets upstate, or in the Hudson Valley Catskills region. And that is sort of the market that we work within, which is a lot of second home buyers, vacation homes, people buying places and wanting to rent them out part-time for Airbnb, then use them for themselves, versus the person who just has a normal job here, is buying a house or is moving from one neighborhood to another neighborhood because of normal family changes or job changes or whatever it is. So our market is different. And that is, to me, that's important because I think that well, I just think that second home markets, behave a little bit differently. And I think ours is going to behave a little bit differently. So if we look at that kind of chunk of the market, that's a lot of what I'm talking about. And that's kind of what I'm trying to keep in mind when I'm looking at all these different statistics and things. So I do want to get into some of the national context first. So we'll just start with like broad international, national stuff. So I think you guys know, I would imagine that interest rates have gone up quite significantly. They have almost doubled since January, still still kind of at the 2008 levels. So not 2000 and whatever, not in the 1970s where we're seeing double-digit interest rates for mortgages. And that has caused a bit of a freeze in the market, I think, or did this spring, where buyers went, oh my God, what's happening? Sellers went, what's happening? Is it the kind of end days? We just saw, I would say, a lot of confusion this spring. Not necessarily massive changes, but just sort of a lot of like, what should I do? Should I put my search on hold? Should I buy now? What's the best? Should I sell now? And the reason that does make a big difference is because, it is just that it's pure affordability. Is that like if you were buying a home a year ago and it was, I don't know, a $500,000 home, maybe your mortgage and interest would be $2,100 a month, and now it's $2,900 a month. That is a big difference. And that is a difference that is, for some people, pushing them all the way out of what they can afford, because the mortgages are essentially, one of the big calculations is the debt to income ratio. So if you're taking on more debt, your income hasn't changed. That is a big difference. Interest rates are still going to be, I would say, one of the primary drivers of, I'm going to call it, possibly lightly decreasing prices till the end of the year, because they look like they're going to go up more. So I would say that, the inflation rate, which this is largely tied to, was 9%, I think, in July or June. And that is, everybody had hoped that the moves the Fed had been making would start to curb that, and it's still going up. And there is a sense that the interest rates that the Federal Reserve are going to have that they are going to keep increasing them, and possibly pretty dramatically till the end of the year. So could we see interest rates of 7 or 8%? Maybe. I'm definitely hearing people talking about, 6s being probable by the end of the year. So when you combine a 6% interest rate with a housing market that had gone up 35% over the past 2 years, that is a huge difference in terms of the price for what you get. So the weird thing, I mean, not that weird, but like basically, if these interest rate increases start to actually help get inflation down, and we start seeing inflation not being such a problem, then the mortgage rates will actually drop. I mean, this makes sense. A bank doesn't want to lend you money at 4% when the inflation rate is 10%. So sorry, I meant if the inflation rate starts going down, right? That doesn't make any sense. Like then they're actually losing money based on inflation. So the banks and the mortgage lenders are really looking at the inflation rate, and that means at some point in time, the Fed could be raising the interest rates, and the banks could actually, or the Fed rate, mortgage lenders could start to lower their rates. And we already saw that once this summer. So I think that's important to know, is that it's not just like, if you see something in the news, like Fed increases, blah, 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 to whatever, then it doesn't mean the mortgage rates go up. It's not a one-on-one correlation for most mortgages. I think that, the side note here is for the market is I think that we are starting to, and we will continue to see some more creative approaches for buyers and sellers to deal with this increase. So we are seeing, first of all, buyers looking at a lot of different lending options. So there was also a fee put on for second homes, essentially. Again, this is sort of a federal Fannie Freddie thing that could cost as much as, around $13,000 for a $400,000 house. This happened early in 2022, early in this year, which was like a double whammy for us. All of a sudden there's the fee, there's the higher interest rates, and the stock market is changing. All this stuff is happening. So what I'm hearing, and I heard from, one lender at Loan Depot, David Rodriguez, is that they're doing a lot more portfolio loans, which means loans they keep in-house that they don't sell on to the, kind of federal agencies. So they don't have to charge that fee. Every mortgage person we're talking to are seeing more adjustable rate mortgages, ARMs. And, the kind of word on the street here is what is it? You're marrying the house and you're dating the rate. So the idea is that, and this is actually, I think one of the most interesting things is that if the mortgage rates go higher and it does cause the prices to go lower here, you might be able to you can get a house for a cheaper price than if we were still at 2.9%. And then you can refinance. So first of all, if you get one of these ARM loans, you still can see rates, closer to 5%. And I think some of the things that we might see buyers asking for, sellers offering are points. So actually covering points in a loan, which means paying a certain percentage of the loan to drop the actual paying that as closing to reduce the interest rate of the loan over the full life of the loan. So I think that there's going to be some creative stuff. I think that you didn't really have to think about it that much before. Like in the past couple of years, you just kind of went to a bank, got a 30-year fixed or 15-year fixed, whatever you wanted. The rates were all amazing. So you didn't really have to think about it. Now, I think people are going to be looking at who can be a little bit creative in terms of these different loan options. So that to me is I think that actually the interest rates weirdly will have less of an impact than you might think when it comes to the end of the year. That's my opinion. I think that people are already getting used to seeing 5%, in front of a number. I think if it gets to 6, I think they'll get used to seeing 6% in front of the number. When we started seeing 5% at first, everybody panicked and actually deals fell apart. So, this was the other thing, and the thing that is happening that makes buying a little challenging right now is that some banks aren't locking for a certain amount of time, or even if you lock a rate, and let's say it takes about 90 days here. It just does, still maybe a little bit less time, but from an actual offer to closing, it can be as short as 6 weeks, but just getting the inspection, the negotiation, the attorneys to do the contract, the title search, all that stuff takes a while. So what we're also seeing is people, as they're getting close to the end of their rate lock, they're nervous. They're really nervous because the new rates might be significantly higher than what they locked 2 months ago even. So we are seeing deals kind of falling apart right at the end sometimes even because they can't, and we're seeing creative solutions where there's the deal, the house closes and then the buyers rent back to the sellers. We're seeing things like that too. So, but I would say that is, it's I don't think that the interest rates is going to be the main driver of decreasing prices. I think it is maybe the main one, but not this is where I think some people look at it and go, wow, if it gets to even 7%, the houses will be, $600,000 house on the market now in Ulster County will be $200,000. I just don't think that's going to happen. I think there's too many other pressures in the other direction. So, and what I can say is that, just again, to put this in a little bit of national context, I got some statistics ready for you guys. So the demand for second homes were 90% nationally above pre-pandemic levels in March 2021. So that basically meant, that almost doubled the demand for second homes since, in that year, the first year of the pandemic. That is a huge increase. And I think a lot of what happened, is that a lot of people who were, the obvious stuff, people were able to work from home. They had to work from home. They had to quarantine. They didn't want to be in an apartment building necessarily. A lot of the amenities and reasons they were living in a city got to be less attractive. And this is happening nationwide, by the way. This is not just New York to up here. This is all over the country. So I think, though, also what may have happened is that a lot of people who were like, someday I'd love to buy a house in the Catskills or Hudson Valley, that'd be awesome. Their plans just might have accelerated. So I think one of my big questions for, that I have with our market is, how much did demand genuinely grow? And how much is demand genuinely growing for buying in this region versus how much do we just cram 3 years of house sales into 1 or 2? And that I think is a really important question, because there are reasons demand is growing. There is still work from home. You can work remotely. This area has gotten more press. It's become, has more amenities. There are towns that had, basically just boarded up shops that now have cute little restaurants and shops and things like that people really enjoy. So I think those are all reasons why the demand is still going to stay high here. But it's I don't know, we don't have statistics for are there now 4 times as many buyers as in 2019? Or if there were 4 times as many buyers, did, 3/4 of those folks already just buy a home in the past 2 years? That's what we kind of don't know. In May 2022, so this was from an On the Market podcast, the demand for second homes was 4% below pre-pandemic levels. So that I think is important. So, you're looking at March 2021, you have almost a doubling of demand for second homes. In May of 2022, it's actually a little bit below pre-pandemic levels. And we haven't seen June and we haven't seen June, we haven't seen July yet, but I think that that's interesting. I think that second homes also are more likely to be impacted by people's overall wealth, and even their just perception of their wealth. The stock markets, people who are invested in cyber currencies. These things all have just taken such a hit since the beginning of the year that if someone does not need to buy a house, they might not. And that's where I think we have a potential risk for things softening a little bit more, is that people will get nervous about their overall, most people are projecting, I would say, a recession that will probably happen, starting this fall. If that happens, people are going to be worried about their jobs. They're going to be worried about the stock market. They're going to be worried about all kinds of things. And they're going to look at what makes financial sense for them to do right now. Interestingly, the interest rates and and just general economic sort of issues, I would say coincides with something that does have an impact prices more substantially up here, which are Airbnb restrictions. So one of the drivers of the increase in prices has been the fact that you can do short-term rentals in most places, and that there's been a robust short-term rental market. So that is something that is no, I don't want to say like being threatened, but like that is something that is changing. You know, we have people who are being elected or running for office locally, county level, who really don't want to see short-term rentals continue to replace some of the full-time housing options. So that is real. And additionally, the occupancy rates for short-term rentals are decreasing. And there was some data from AirDNA, which has a lot of, you know, they're the ones who record a lot of the stuff. And they were, that one I don't think I have in front of me, but basically they essentially saw that there had been an increase in the number of Airbnbs or short-term rentals of, it was around 26% from this year to last year. So that's a huge increase. And then a slight decrease in the occupancy rates and a, you know, like increase in revenue per night, but pretty modest, like 3%. So what I can say anecdotally is a couple of things. One is that I am hearing from more people who own Airbnbs up here in the Hudson Valley Catskills that their occupancy rates are lower, that they're not, I mean, and it's like, obviously they're lower than 2020 when everybody just like wanted to get out of the city. They needed a place to go. If there was broadband and like, you know, that was kind of the only requirement. So, but they're just feeling like they were lower. The people that I'm talking to also had places that were being rented pre-pandemic and they feel like they were lower for that. So that is kind of that would be a big deal up here. So I think that the restrictions, there are some towns that are switching to having sort of restrictions so that you can only rent if it's your primary residence and you're on site. So you could rent like a guest house, but not like, or a room, but not like your whole house. Or you could rent your whole house, but only if it's your primary residence, only for a certain number of days. Like it seems like most towns are enacting some version of this, some more stricter than others. And we are at the point, and kind of have been for a while, where I tell people, don't count on that income. Just don't assume that you can do short-term rentals forever. And it's certainly not 365 days a year or even if you just use it as a vacation home. If you want to use it 3 months a year and rent it the other 9 months, you know, with your weekend, you want to go up for 3 months in total, weekends or weeks, then I wouldn't necessarily assume that you'll be able to do that in 5 years. Kind of a different topic, but to me, that is one of the things that we're seeing for the prices that I think might also cause them to soften somewhat, is that people are starting to sell their Airbnbs. So we are starting to see that because they're in towns that are making regulations. They can't sell them. They think it's like a pain in the ass, or they're feeling the risk. And so we're starting to see those Airbnbs come on the market. Now that'll help the folks who still have the Airbnbs with their occupancy rates and everything else. But, you know, that could be a big factor there. I would say that, you know, and I think I put this in the description. We have, I think, around 165 deals for our team that were closed or pending for this year. So we do get a pretty broad spectrum. We get to see a lot of data and, you know, offers that come in, and our buyers agents who work with buyers and they don't get a house. We are monitoring all that stuff. And I would say still that like 80% of people we work with want to be able to Airbnb a place some of the time. They would rather not just leave it empty, even just because it's a little scary to have a, you know, house empty while they're not there. And they are also not necessarily looking for people to rent things long-term because they want to be able to use it. That's sort of the model that had been one of the things really driving price increases here, is that people could afford a house that was more expensive because they knew they'd be able to Airbnb it for some of the time. Just like a safety valve, even if they didn't do it. So that to me is pretty important. You know, the kind of weird national news is that the Let me look at this stuff. I'm trying to find the statistic I was looking for. Right. So I think this is Redfin data here. I'm just gonna, I like literally do not have my my progressive lenses. I can't read well enough. This is so embarrassing. Redfin, yes, there we go. Okay, amazing. So the week for the week ending June 30th, the 30-year, well, we don't need to say that one. The seasonally adjusted, this is what I was trying to find. Seasonally adjusted Redfin homebuyer demand index was down 15% year over year during the week of June 26th, but up 7 points from the previous week. So it's interesting. So like it's down 15% year over year for that week, but it was up 7 points from the 7% from the week before, which kind of, I think my sense and what I'm hearing people saying is that people kind of freaked out and now buyers are coming back in because they're seeing some opportunities here. Mortgage applications are down 24% from a year earlier, which is, significant. But the other piece of this that is confusing both nationally and upstate is that there still is, yeah, there we go. Thanks, Danny. See, I said 26%. I was very close. Amazing. Thank you for sharing that. So is that there's no inventory. So that is really a problem, right? Is that so we're not going to see, so we are still, let me put it a different way. For homes that are turnkey, look great, can be short-term, can have some short-term rental income, they are absolutely still getting multiple offers and going above ask. Again, nationally, the numbers of homes that are getting multiple offers is down, I think, to around 50% for the first time in ages. But really, this is, we are seeing on our buyer's agent side that they are still 1,000,000%. If a great house comes on the market, they're getting the call, they're getting that email from the agent saying, hi, the best has been called, or the house is gone before they can even show it. So that is a big deal. The active listings was currently nationally is 8% down year over year. So, I mean, this is still like this was already tight inventory. This is not great. Some of the other statistics are pretty mild, like 32% of homes that went under contract had an accepted offer within 1 week versus 36% a year earlier. The median, price of being on the market until you get an accepted offer or went under contract, depending on where you are, was 17 days. Is 17 days, sorry, and I'm slide from the record low of 15 days set in May and June. Down from 18, so it was 18 days in 2021 and was actually down to 17 days now, essentially. So that is not a lot of difference, right? So I think that's sort of what's tricky. And the median asking price is still was up again 15% year over year in the June numbers nationally. And that's also what's causing the prices of rent increasing. I think the way that media presents this is always like landlords raising rents at record rates, like going crazy. And I'm sure there are some greedy landlords out there, but if you buy a house from someone for $600,000 that they bought for $150,000, your mortgage is going to be way higher. So you probably can't charge the same amount of rent to even break even. So as long as the house prices are going up, rent prices are going to go up. And I don't know if you guys saw this, but Manhattan, it was over $5,000 a month for the average apartment for the first time. And I think that weirdly is one of the factors that could help us up here if people do start saying, screw it, I don't want to deal with how hard it is to get an apartment in the city. I don't want to, I'm just, that was what we were seeing before the pandemic too, was just people kind of making a financial and lifestyle decision to move here. So if we look at New York State, it's really similar to the national stuff. It's 13%, year on year change in price. This is all for June, minus 14%. There's 14% fewer homes for sale. So that is actually more dramatic than, the national average. And then I think just because of the time, I'll go to some of the local stats, which is Ulster. I'm just picked Ulster County and Sullivan County just to give us a couple counties to talk about. But basically, my gosh, why can't I read? My poor eyes. New listings were up. There are 330 new listings in June versus 281 same time last year. The overall houses for sale, though, is lower, 652 houses for sale versus 732 last year, which means that there's still less inventory than there was last summer. Closed sales is also down, 160 this year versus 207 last year. So, there were in spring, there were more deals that fell through than I think I'd read anytime since 2015 or maybe even before then. So deals were falling apart because the mortgage rates were rising so high that they were, they would not qualify. They would see a house, they would have been qualified and then not be able to afford it by the time they got to closing. All kinds of stuff was happening. People were just freaking out about the economics. So that makes sense to me that there would be fewer closings. The median sales price in Ulster County is $377,000-ish, up from $350,000 in 2022. Again, we look back to 2018, 2019, you're in the 200s. So that is a difference. Sullivan County, interestingly, had fewer new listings, also 193 new listings versus 224 last year. 160 closed sales versus 207, and 888 homes for sale versus 1,022. Sullivan County's median price, see if I can make this bigger. Oh my gosh, so embarrassing. Was 200 and, oh yeah, sorry, actually went down. 235,000 versus 250,000. So Sullivan County was interesting because it is the one that has actually seen the median price go down already year on year. So I think that, looking at these things, I guess the one other factor that I wanted to mention was just that, people look at a couple of times, nationally, people look at 2008 when there was the, big housing boom and crash. And I found one chart that, it's just the number of foreclosures that we have now is just a tiny fraction of what there was back then. And I think that it's just important to remember that a lot of the problems back then were due to really wild and often predatory lending practices. So there were a ton of people with their homes underwater, AKA they owed more on their homes than they were worth. And now, even if somebody bought a house in 2021, they probably still have equity in it. Because they probably had to put down 20% or close to it. They probably had better, they're probably better off financially. And except for, again, in Sullivan County, where the median price went down a bit, the prices are still going up. So I don't think that was one of the big drivers of the last housing crisis that was such a shock to the system, is that it was a long and tough recession. And there were just a ton of really unsteady, shaky loans out there that house of cards fell. And, millions of homes came back on the market. So that's one of the things I wanted to mention as a difference. Another point in time that people talk about for Upstate is September 11th. Was another time when a lot of people from the city moved upstate and prices got really expensive and people felt like, oh my gosh, what's happening up here? It's changing so quickly. And then it seemed like, thanks, Jared. Yeah, homeowner equity is over 40% nationally. So that is really high. That means that even if you had to sell your home less than what you bought it for, anyways, yes, we are probably not gonna see a lot of foreclosures. So when people moved here after September 11th, and I was not here then, but I think that there are at least two really big differences. And one is, I guess it's one that's kind of combined, is that there is so much broadband everywhere upstate now. So that is, you can be in a cabin out in the middle of the woods and be able to like work effectively from home. The other is that a lot of companies are letting people work from home. So that is like, if you were going to leave the city back, after September 11th, you would have had to like pretty much leave your job. Like there were not as many work from home opportunities. And that is to me, a huge, huge difference. Also, this is where the Airbnb stuff and the short-term rental stuff is kind of interesting. That wasn't as big of a deal then either. It wasn't even founded back then. So I don't think, I have to look back and see when Airbnb was officially founded, but I think it was sometime in like a little bit more later in the early 2000s. It was certainly not as big of a deal, let's say. Now, let's say somebody buys a place, they move upstate during COVID. They're like, this is cool, but I like have to go back to work in the city, or I want to go back to work in the city, whatever. I still just want this place as my weekend home. And I know I can Airbnb it and get a bunch of the, costs paid for. So it's not like, it's not, you don't have to, they could actually have both and have the home upstate pay for itself if they're in a place that allows Airbnb and they, are getting the right occupancy rates, et cetera. So I think that is a huge difference. So we're not like, the people that we're seeing come to us to want to sell their homes are people who are like moving to California or do have some like big life change. We did not see, I know everyone was kind of like, oh, well, the New York City people are going to come upstate and think it's bullshit and then leave. But I think that this kind of gets back to my question of like, how many people were secretly hoping and dreaming of buying a home upstate in 2019? If it was like, I don't know, let's say it was 50,000 and a bunch of them accelerated their plans. Does that mean like they would have bought this year and next year? Or are we still just growing the total number of people who want to buy homes upstate because this area is getting more attractive and you have the broadband and work from home? So all that to say is that I think that where there are opportunities for buyers and where sellers probably need to be very realistic is, again, if there's anything wrong, like if there's anything that is, I don't know, like you have low ceilings, you have a super visible neighbor. And again, this is a lot of things that bother people in the second home market. There's one bathroom only. There's noise from a nearby road. Like any of these things that, again, like the past 2 years, people would have kind of been like, nah, we can live with it. They're kind of punishing those sellers now. And not like crazy, we're still getting most of our things are selling very close to the asking price and very quickly compared to, what they would have sold for in 2019. But just like not we used to put something up, we'd have multiple offers the first weekend. And on average, it was 19% over ask. That was pretty standard for most of 2021 and the beginning, most of 2021, some of 2020. And that we're not seeing as much, even when there are multiple offers. Sometimes the multiple offers are below ask or at ask or near ask. So it's, again, we're still 1,000,000% seeing so I think this will last till the end of the year. The super awesome house, like the mid-century modern house that's on a cliff with a creek that is turnkey, that is going to like probably have multiple offers because there's going to be people from all over the place who want to buy it. A house that has any kind of is sort of more of a normal house is going to be a lot harder. So I think that is, for sellers, what we're doing now for our listings is trying to be, well, the other thing is that like, if a house was purchased for 700,000 in 2021, with the increase in the interest rates, just to pay the same monthly amount, the price would have to go down. So, the fact that the prices are still going up or still up year on year, 14%, means that like the actual monthly outlay for people is up much higher than that. For buyers, we're seeing that there are some opportunities, and there are some opportunities for these deals that have fallen apart. And again, I don't love a deal that's fallen apart, but like for buyers, those are things where they often fall apart for no reason there's nothing wrong with the house. There's nothing wrong with anything. It just is like someone changes their mind, or they like get freaked out, or someone tells them that neighborhood is stupid. So like, we're seeing that. We're seeing our buyers agents are starting to look at homes specifically that have been in the market for 30 days or longer, or even 2 weeks or longer, because some sellers are getting nervous. And again, keep in mind, these are just people. So you have people who have their own opinions, whether their opinion is like, it's good, I can like wait forever at this price, or their opinion is like, or not opinion, might be the situation, I need to sell because I'm moving to a different place. It's all individual. So, but I do think that, the other area that buyers might have some room for a little bit more negotiability kind of is with new builds, because the nationally new builds, the demand has been going down even more than for existing homes or for, resales. And I think that, builders and developers are in a little bit of a tricky situation, because if their product isn't going to be done for a year, and they are still going to have supply chain issues and labor issues and all kind of things, they can't price things too low right now. Otherwise they might really risk losing money later. But I do feel like they're also getting to be more discussions about certain things. Like maybe there are ways to save money by not having a certain piece of it, or changing a certain material. And some of them might have other, possibilities. So I think that's about it. But I think that the fact that building materials, that is also goes into, inflation makes building materials high, yada, 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 yada. So, it eats away at the potential profit a developer would have if they wanted to get, 20% profit or 10% profit, and there's 10% inflation. Now they would basically be breaking even. So it's a really tricky time to be a developer, I would say. But that's where there might be some opportunities for buyers to kind of work more in creative ways. So I don't know if anybody else from my team, if anybody has any questions, they can write them here. But if anybody, from my team wants to like say anything that I haven't said, or like, I think that, I guess that my main point here is that last time I came on here, I said, I think we're still going to go up, but up slowly. I actually think we're going to go down now, but go down slowly. So that's the main takeaway. I also think that shouldn't make you buy or sell. And you buy or sell based on your individual budget, the time you have, like if a house works for you or not. It is real hard to time the market. So, somebody asked what we're seeing with cash offers, and cash offers are still winning a lot of the time. And weirdly, I think that might get worse as we move into this period, because I think that there are some investors who are looking at this and going, oh, we can start to have some bargains now, so like, let's take our cash reserves and start to buy some things where maybe they didn't 6 months ago. One of the interesting things I heard an investor talking about how the deals they were finding were actually all on the multiple listing service. They were all publicly listed. They weren't off market deals, because some sellers hadn't kind of realized yet that the market had shifted. And so if you've been on the market at a price you think you're going to get, and it's been like 6 weeks, or like for us, we can say to our sellers, like, hey, we had 37 showings. We had 6,800 people watch this video online. 842 people shared it with a friend. Like, if you haven't had an offer now, that is like the price is too high, probably. So interestingly, that real, like we used to think that you could get like an offer, get like a special home by doing it, off market or an office exclusive kind of thing, or people, we're talking about that a lot. I would actually say if you're a buyer, to look for the things that are on the market and have been dragging a little bit, having a couple of price reductions. Contractors are still incredibly hard to come by. And I hope that might get a little bit better. And that would be partially because of the interest rates are also discouraging some people from refinancing to do home renovations. So I think that we're seeing a lot less pressure on the whole system because of that. I mean, that's the good part of the higher interest rates, is that, the lawyers are a little less busy, the inspectors are a little less busy. So far, the contractors are not less busy, but to me, it stands to reason that would happen. Oh, certain price points that are more affected. Thank you, Mallory, for asking me that. That was one of the things I asked. I mean, this is just anecdotal with the buyer's agents on our team, but what I asked them was, are you seeing multiple offer situations in any particular price category? Like, is it only houses of 400 and under? And what they said was that it's not, like, and there are 9 of them. Like they said, it's not a particular price point. It is, what it is a house that seems like a value, or something that seems like a value. So it's like, it could be an $800,000 house that maybe last year would have been like, you would think you would see it for 900,000, or whatever. Maybe it's 850 and maybe you think should be 900. And also the ones that are, 400, 350, et cetera. But yeah, no, it doesn't. I think that the lower, I mean, for sure, for the second home market, it's a weird one. I mean, so it's like, but people at the bottom end of the market, I think, are more likely, like, they can't go down much further. So they're more likely to come out of the market completely because they just can't afford it with the interest rates and the price increases, or they can't afford something that they would want. So, you're looking at a house now for 300,000 that would have cost 200,000, whatever, or like 220, like 2 years ago, and it's going to be expensive because of the interest rates. So those guys might just choose not to buy. And we are seeing that because they don't have to rent, so that's a difference between like a regular market and a second home market. If you like are looking at high rents versus having to buy, you might still buy. But if you're like, I'm going to get a second home and be able to do this dream of mine, you might just be like, I'm going to wait. So I would say that the other piece of that is at the bottom of the market. Like, we used to be able to find relatively decent homes for like 300 and below, 400 and below. Now it's like, it still is it's hard, like, until you get, above 400, there just aren't a lot of options, and they go quickly, and they are more likely to have cash buyers if they're attractive. So, Seb is asking, how are most permanent town residents reacting to short-term rentals? Are they pleased with the tourism, or do they make up the majority of people who are pushing towards ending short-term rentals? So that is a weird question. And it's not a weird question, great question. It's a difficult topic, because there are people who are, who, first of all, there are permanent town rent. Like, I have lived up here full time for 6 years, but I will always be considered a newcomer because I am not from here. There are people who have been here for 4 generations who have short-term rentals. It's been an incredible, so it's not even just that they're happy with tourism, but they're actually happy with the ability to rent out a house or buy a home or rent out their guest house and be able to earn income. So it's actually not as strict a divide as I would think it would be. And I think that, affordable housing it is like a real crisis nationally and here for sure. I think that short-term rentals are part of the problem. Zoning is another big part of the problem. You can only build 1 house per every 3 acres. Like, that makes it hard to develop critical mass, but then there are issues with water and septic that may get tricky. So there's a lot of talk in general about housing affordability. And I would say, interestingly, that the only people who like tourism are people with shops or restaurants. So what is unexpected, well, maybe it's not unexpected, because maybe it just is like it's just gentrification in a slightly different way. But when a town gets like a cute shop in it and like a, great new restaurant, whatever, the people in the town get worried because they start to see some people will get worried because they'll start to see how that will impact the price of housing for them. So it's like, in that case, you don't even want tourists to like discover your town, because it's just going to mess you up for housing, or your friends or your kids, or, whoever it is. So it's a really tricky issue. And it's one that I think a lot of people are tackling in a lot of different ways. And from things like, different towns are passing rules to allow accessory dwelling units, so that if someone has a house, then they could build another little unit that could be rented out for long-term rental or short-term rental, depending on the town. There's good cause eviction laws being passed in different places, which is kind of tricky. It makes it, it's good. It's great for tenants. Tenants basically, when a house gets sold or when a property gets sold, the tenant essentially can't be evicted, even if the lease ends or the property gets sold, unless there's cause. And the landlord has to go before a judge and to, show cause for that. So that's been another thing that has actually muddied the waters a little bit, in terms of people who, I used to always say, like, if you can't do short-term rental, there's always going to be demand for long-term. Some people are nervous about this good cause eviction stuff that's passing in different places like Kingston and New Paltz and possibly the county. So, because they're, if you can't sell your house or use it, it's tricky. So is there any distinction between drivable versus more walkable areas like Kingston, Newburgh, Ellenville in terms of price or activity? I would say in general, the more walkable areas are actually always cheaper. And the reason is that most people who are looking for a second home, haven't traditionally been looking for that kind of walkable lifestyle. So they want to be in the woods and look at trees and have like the exact opposite of what they're looking for. And it is the second home market that is the higher price point. So for sure, if you see like an amazing home in Kingston that's like great design, whatever, that is going to still be a high price. But I would imagine if you took that same home and plopped it in 10 acres in Woodstock, it would be still higher. But again, that could change. Anyone have any other questions, comments? Want to call bullshit on anything I said here? I mean, I don't think I said anything too wacky. I just, unfortunately, humans are, not unfortunately, but like like buying and selling homes, and especially second homes where it's not, you don't have to necessarily do it. It can be driven by emotion. It can be driven by fear. It can be driven by all kinds of things. And so, a lot of what will happen in the coming months will be how many headlines there are that are like, housing market tanking, just stuff like that is really, really can make a huge difference. So I do want to just end with saying that, our website is upstatecurious.com. If you're interested in buying or selling, you can find little questionnaires to fill out for either. Whatever you're thinking about, if you're vaguely thinking about it and not working with an agent yet, start having the conversation early with the agents on our team, because we are talking about all this stuff all the time. They're really working hard to help the buyers and sellers move through this market, talk about things like timing, see if there's a perfect house for right now, or like a price that would be great to sell at right now. This is the stuff that we kind of live and breathe, and it is never too early to talk to, any of the agents on the team. If you're thinking about it a year from now, great. It is fantastic to start now. So yeah, upstatecurious.com. My name is Megan. And if nobody has any other questions, I guess I'll let you guys get on with your day, and I hope everybody stays cool. Anyone who's in the New York area or a lot of the country that is baking right now. So thanks very much.